for our third quarter webinar for this year. The theme of today's webinar is the Nigerian's economic landscape, an overview of quarter 3, 2023. My name is Folake Osho, and I'll be moderating the session. Before I call on our host for today, I would like to share some basic information with you. Please note that questions will be taken after the host is done presenting. Kindly drop all your questions in the chat box visible on your screen. And also note that the webinar is currently being broadcasted live on Facebook. If you have any questions in respect to Cowry Asset Management product or our services, just like the adverts you saw now on our mutual fund, our dollar-denominated mutual fund, please feel free to send an email to info@cowryasset.com. So without further ado, I would like to invite the host, is the MD CEO of Cowry Asset Management, Mr. Johnson Chukwu. He has over 3 decades of experience cutting across the capital markets, the oil and gas industry, and the banking industry. He's also a fellow of both the Institute of Taxation and the Institute of Chartered Accountants. He has also attended several courses, both locally and internationally, including Stanford and Harvard Business School. Sir Johnson, we're happy to have you here. The floor is yours, sir.
Thank you, Folake. Good afternoon, everyone. Today we'll be discussing on Nigeria's economic landscape, an overview of the Q3 economic indices, indicators, and then try to hazard a guess on what the future looks like. Once again, it's all our pleasure in Cowry Asset to welcome all of you, our distinguished and esteemed guests. Many of you are our customers, some of you are customers in the waiting. And like Folake said, we will take questions after the presentation. I try to make the presentation as brief as possible. Let's go to the first slide. Can anybody hear me? Okay. Can you hear me?
Yes, we can. Loud and clear.
Okay, so let's go to the slides. Well, as you may know, oil prices actually topped $95 in April. Interestingly, it's dropping. So, like I was saying, oil prices topped rose to a 10-year high due to OPEC and OPEC Plus supply cuts, with Brent crude reaching about $95 in September. Prices are high, but expected to remain high out to December. Interestingly, we've seen price moderate since yesterday. As at the last time I checked, price had dropped, Brent had dropped to something in the region of $84 per barrel. The basic thing that's happening since yesterday is that, as you may know, the U.S., for the first time in its history, ousted the Speaker of the House of Representatives. Of the British, of the UK, US Parliament for the first time in the history of America. So there is a lot of uncertainty. One, some people are describing it as a coup, indicating that Donald Trump may have an easy ride securing the candidacy or the of the Republican Party. So there are a lot of concerns about that we have as it relates to the accommodation that they just granted the federal government, the US federal government, excuse me, of about 30 days. So the concern that if they have a speaker that's an adversary to the president of Biden, they might shut down the economy. And that means demand for many input materials will decline. And that's what we saw for the first time in a couple of months. Oil price started tanking yesterday, and it's still tanking as of today. The world economy is expected to grow at about 3% in 2023. The growth will likely be driven by Asian countries, despite the weaker than expected recovery in China, according to OECD. The resolution of the US debt ceiling issues has lessened the threat of abroad interest rate hikes on government debt. Like I said earlier, but it was a temporary accommodation that was granted to the U.S. government. But the concern that it could that there could be a hike in interest rate, or there could be a default by the U.S. Treasury, which will ordinarily trigger a financial crisis. So you can understand how traders are thinking that if the new speaker is elected in the U.S. Congress and is adversary to Biden, they will shut down the government, and then it could lead to a spiral effect on the financial system or the global economy. The Federal Reserve Bank, the Bank of England, the Bank of Canada left interest rates unchanged in the month of September. Of course, Nigerian Central Bank couldn't hold its MPC meeting in September, but what the major consideration for them was the weaker than expected economic growth rate. Of course, the economy has been projected to grow at just 3%. The declining high, of course, there has been also been declining high headline inflation rates. Energy and food inflation has slowed down significantly in the past couple of months in advanced economies, although core inflation has remained above central bank's targets. China's much expected economic recovery or rebound after reopening its economy has remained lower than is projected due to slower real sector growth, failure to address real estate's evolving financial crisis, and lower than expected consumer demand. Then, as part of strategies to counter Western economic blocs, Britain, Brazil, Russia, India, China, and South Africa, the BRIC countries, expanded their membership by accepting the application of 5 new members, bringing its share of the global economy to 30% of the global economy and 47% of the GDP. Sorry, 47% of the world population. Of course, you know, India and China are the most populated countries in the world. Both of them are in the region of 1.4 billion citizens. Economic difficulties and constricted political systems seem to have resurrected coups in some African countries with recent military takeovers of government in Mali, Gabon, and Nigeria, and a couple of other West African and Central African countries. Of course, we know that the issues around Mali, around Nigeria, are because of the severe economic difficulty most things are going through, and therefore that's encouraging or emboldening the military to take up in these countries. These are just a summary of what has happened in the global economy in the past couple of days. Going further, looking at the Nigerian economy, we know that the federal government on 29th of May removed the subsidy on petroleum product on PMS, and subsequently harmonized the exchange rate. So efforts by the federal government to address 2 of the biggest leakages in the Nigerian economy by unifying the foreign exchange rate and removing fuel subsidy seems to be unraveling due to lack of sufficient foreign exchange reserve to stabilize the local currency and the continuous increase in global oil prices. Of course, we saw exchange rate breach the 1,000 naira to dollar benchmark or psychological level, and that has created a lot of panic, but we dwell a lot more on that. GDP has averaged 2.41% in the first half of the year. First quarter of the year was 2.31%, and second quarter of the year was 2.51% GDP growth rate. Inflation is at a more than 18-year high at 25.8%, the highest we've seen since August 2005. And we've seen consistent inflationary increases in the past 8 months. Of course, we know it's driven by pass-through effect of exchange rate devaluation and increases in food prices, as well as increases in petroleum product prices. President Tinubu has fully considered his cabinet with the swearing of 45 ministers. The responsibility of steering the economy out of the current challenges was assigned to Mr. Wale Edu, a long-term associate of the president, as the Minister of Finance and Coordinating Minister of the Economy. Mr. Tinubu also tapped on another ally, Mr. Olayemi Cardoso, to head the central bank as governor. MPS reported a flat trend, 4.1% Q1 2023 unemployment rate, even down further from the 5.3% they also reported in the same report for Q4 2022. Well, the key thing that they used a methodology that most people are thinking makes a mess of the purpose of the publication, because if you have a data report or a report that shows the economy has an unemployment rate of 4.1%, it could mislead decision makers to think we have near full employment, when in reality, the country is suffering from a very severe unemployment level. So people have begun to question, or people have been questioning the change in methodology that the MBS adopted. The CBN, as we may all know, released its financial statements for 2015, for the 7 years, 2015 to 2022, marking the first such publication in 7 years. The publication unfortunately brought to the fore the precarious state of Nigeria's foreign exchange position and contributed to moves by business to front-load their forex demand. So basically, by the time Central Bank came up, the figure they published indicated that we have a net reserve of about 18 billion, which the other publications have come to question even that net reserve of about 18 billion. We'll come back to that. The Naira bridge, I mentioned the psychological rate of 1,000 Naira to US dollar at the parallel market, causing concern among citizens and business about financial stability. While the parallel market rate tested new lows, the Central Bank of Nigeria seemed determined to maintain an artificial rate at the NIFEX market, that is Nigerian Interbank Foreign Exchange Market. That is what I&E, Investors and Exporters Window, has been renamed, by keeping rates around 755 Naira to a dollar. But the implication is that we have seen a widening in the spread between the official rate and parallel market rate of more than 30%, because you have a spread about more than 254 Naira to a dollar. Of course, that's one of the reasons why I said the effort by the federal government to address the two biggest leakages have now seemed to be unraveling. In the first place, we've seen the spread widen to about over 250 Naira, about 254 Naira to a dollar, which was about the same rate that we were dealing with before the harmonizing exchange rate, which also means that the opportunities for economic growth have re-emerged in the economy. Let's look at let's dive in on some of the global economy. I know, like I said, I'm going to try to make it as brief as possible since there will be question and answer session. I did mention earlier that the IMF had projected a fall in GDP, which is the reason why the Bank of England, the Bank of Canada, and the US Reserve Bank all kept rates low, stable, did not move rates. From the IMF had projected that the global economy would drop from, or decline from, a growth of 3.5% in 2022 to 3% in 2023 and 2024. Of course, that was a slight upgrade when you compare it to the 2.8% they reported in April. The recent, I mentioned the recent resolution of the US debt is a crisis, which or dispute, which albeit is a temporary measure, has at least lessened the immediate threat of financial crisis. But the concerns have re-emerged with the change in the leadership of the US Congress. The slow growth in the slowdown in growth from 2020 to 2023 is largely attributed to advanced economies. Of course, advanced economies are the ones that will grow least, because Asian economies are, like I mentioned earlier, will still be growing. China grew at up to 6.3%. But the problem the advanced economies have is the weak manufacturing sector, which is counterbalancing growth in the service sectors of these economies. In the second quarter of 2023, the US saw a 2.4% year-on-year GDP growth rate, representing the most robust performance in 5 successive quarters. China's economy grew at 6.3%. I mentioned that in Q2 2023, even faster than the 4.5% it grew in Q1. Of course, we know the base effects of that, the fact that the previous comparative quarter of last year was still a period when there was a lockdown in the Chinese economy. So the base effect had contributed to that 6.3% growth. UK GDP growth grew at 0.6% year-on-year in the second quarter of 2023, slight improvement of 0.5%, while Canada grew by 1.1%, a decline of from 2.08%. The European zone economic zone grew by 0.5%, marking the slowest growth rate since 2021. The global economic risks are still leaning towards the high inflation rate, concerns around financial markets, the promotion of the Chinese economy, and debt distress due to high borrowing costs and geo-economic fragmentation. So I'll skip through some of these areas that since we're going to share this for a lack of time. IMF projects a headline inflation could fall to 6.8%. I'd say that headline inflation has been declining in major economies, but core inflation has remained obstinate. Headline inflation is driven, the decline in headline inflation are largely driven by volatile items like food and the energy costs. Energy costs have moderated in many economies, as well as food prices have also moderated in many advanced economies. So most economists are expecting a lower inflation rate in 2023. I had also mentioned earlier that the U.S. Federal Reserve Bank, in its policy meeting in September, kept federal rates at 5.25%, at between 5.25% and 5.5%. On the converse, ECB have increased its rate for the 10th time, although they are suggesting that they may not continue to increase in coming meetings, citing that inflation is beginning to moderate, and that should make them not increase further. Of course, no economy has attained the 2% benchmark for the central bank's target inflation rate. Okay, I did mention earlier that the BRICS, which is Brazil, Russia, India, China, and South Africa, at their meeting in South Africa, actually admitted 5 additional countries. Those countries were 6 additional countries, which were Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. Of course, we know there was a lot of noise in the country that we were not even admitted or were not invited. But it is what it is. Our economy is not seen as attractive enough to invite us to the BRIC countries. But the basic thing is there's a South-South, there's now a South-South economic bloc that's evolving. They are even mounting that they could junk the use of dollar as a medium of, as a global currency and evolve their own currencies for trading among themselves. But the fact is that with a population of 47% of the global population, about 36% of the global GDP, this economic bloc, should they get their ass right, could be a threat to the Western economic blocs, particularly if they can have bilateral trade among themselves and they have a means of settlement that bypasses the US dollar. Then we did mention that because this is a warning to African countries, we've seen the worsening economic difficulty and perverse systems of muscling the political space and denying citizens of the opposition to choose their leaders through credible elections can be said to have triggered an unexpected resurgence of military coups in Africa. In addition to that, misruled bad governance, colonial legacies, particularly the French-speaking West African countries, extended tenure of government where you have sit-tight presidents, and electoral misconduct are among the factors fueling coup in Africa. We've seen following countries suffer from military coup d'etat: Mali, Tunisia, Guinea, South Sudan, Burkina Faso, Niger, and Gabon. Of course, there are issues with problems. There are problems associated with coup. They lead to trade disputes, trade disruptions, political instability that could hinder trade routes that can lead to higher food prices. We are seeing that being witnessed between Nigeria and Niger Republic. Refugee influx and regional instability, as this could spread, they can serve as incentive for countries, other countries' military, to also attempt to take over power. Now, going to the domestic economy, we've seen the Nigerian GDP, like I mentioned earlier, grew at 2.51% in real terms in Q2 2023, an improvement over the growth of 2.31% in Q1 2023. In nominal terms, the GDP aggregate for Q2 was a 52.1 trillion naira. If you compare the 45 trillion naira in the second quarter, that was an improvement in nominal terms of course, nominal terms also recognizes does not adjust for changes in price level or calling changes in price level as well as changes in exchange rate. So notably, interestingly, the service industry is actually the one taking the lead in driving economic performance. We've seen that sector now beginning to contribute 58% of the GDP. Agriculture has remained at 23%, while the industrial sector is 18.56%. Oil sector is still grappling with so many difficulties. We saw a 13th straight quarter contraction in the oil and gas sector, resulting in the contribution of that sector, which generates about 90% of foreign exchange earnings. The oil and gas sector only accounts for about 5.34% of the overall GDP. Now, the next slide is shows you the domestic economy, the non-oil sector, the sectorial contribution of the domestic economy. I hope you can see what I mean. Yes. So this shows you the sectorial distribution of the Nigerian economy. Agriculture, as I mentioned earlier, in Q2 contributed 23%. Information and communication technology. I always like to dwell a lot on this information and telecommunication sector because it was a sector prior to 2000 that was an inconsequential, insignificant sector of the economy. Today is the second largest contributor, almost 20% of the GDP. And in the not too distant future, it's likely going to overtake agriculture sector. But beyond that, it has enabled several other sectors of the economy. The electronic media, the online media, including our entertainment industry, are now riding on the back of the information and telecommunication sector. Trade sector has remained at 16.77%. Manufacturing sector at 8.6% of the GDP. Mining and quarry. When you say mining and quarry, this is where oil and gas sector, which accounts for about 5.34%. So when you add other mining, solid minerals, it accounts about 5.57% of the GDP. Your real estate sector is 5.28% of the GDP. Financial service industry, 5.26%. Construction, 3.23%. And down you go, including professional. So you look at, now we're talking about inflation. I had said extensively that the inflation rate had gotten to 25.8%. An 18-year high when compared to because it's the highest since August 2005. Then, if you now consider the fact that today food inflation topped 29%, and then because for an average household, the basic thing that you look at, an average household consumption pattern. What actually hurts most average household in Nigeria is cost of food. And that's why when you tell Nigerian that the food inflation is just 25%, they're looking at what is happening to my pocket. I'm actually having an erosion in my purchasing power by more than 25%, because most of the things you spend on are food and food items. So you saw a food inflation rise to net 29.35% in August, marking the highest since September 2005, when it was 29.5%. And unfortunately, most of the food we eat are homegrown food. Of course, we know the problem with food production is insecurity around the food belts of the country, the north central, northeast, and northwest. So until we address that, we may not be able to put a hang on the food inflation. Core inflation was at 21.15%. But the core inflation has been adjusted by NBS to exclude not just volatile food items, but also exclude energy items, which includes your fuel and other energy sources, because they also believe that energy costs has also become volatile. So we go to the next. Unemployment, I had made passing comments on unemployment figures. The last actual reliable unemployment figure was that of Q4 2022, when the unemployment rate was at 3.3%. But now the NBS is telling us that unemployment is 4.1%, and they're using some of the parameters they're using to measure unemployment are things that we believe are clouding or masking the purpose of this unemployment report. We've seen their methodology now includes that a 1-hour work will now qualify as being employed, while previously it was 20 hours work. They've expanded the labor force from 15 years to 64 years to now 15 years to infinity. But I wouldn't know how many 80-year people are working or 90 years old people are working. So they are counted as part of the labor force. So you have a huge base now. But the basic thing is that we now have a report that is unusable because you can't use it to make a decision as it relates to where to look for, how to address the level of employment in the country. Let's go to the next. Now, talking about what has happened in the past, when Mr. Tinubu was sworn in as president, he appointed Mr. Jim Obase, who is the chief executive officer of Financial Reporting Council, to investigate the Central Bank of Nigeria, and then immediately he had suspended the CBN governor. Of course, we know the information we have is that the CBN governor and the deputy governors have already signed. A new set of executive board have been appointed for the Central Bank. But during the period of the interim CBN governor, or the acting CBN governor, the Central Bank came up with the publication of their financial report for the past 7 years, and indicating that our reserve, net reserve, is about 18 billion. After adjusting for what we may call forward transactions and currency swaps. But unfortunately, or interestingly, next slide, JP Morgan came up with their own publication of what our reserve should be, and they estimate that the reserve is actually just about 3.77 billion, after they had adjusted for about 21 billion in swaps and another 7 billion in forward, in FX forwards. So, and as well as 5.5 billion in securities lending. So, but the implication of that, go back 2 slides back. The implication of this is that investors or people who have foreign currency obligation in the near future panicked, and they are out trying to front-load their demand because with that, they were concerned about the sustainability or the sufficiency of our reserve if we have a reserve of only $3.7 billion. Of course, that has had a direct impact on the exchange rate. We know that by the time the Central Bank harmonized the exchange rate, it was about 664 naira to a dollar. Today, we are talking about 1,000 naira to a dollar for transfers. Then other things that are hurting the country is that, of course, we know the Central Bank under the immediate past government granted ways and means accommodation at about 23.18%. Because it's necessary I mention this because the part of the pressure you have in inflation rate is that this excess liquidity that was injected into the economy that was not backed by productivity is still there in circulation. You need to mop it up before you grow the economy to the point that there's enough productive goods and services that will absorb this level of liquidity. But in the absence of that, until you achieve that, you still have to deal with excessive liquidity coming from ways and means. Of course, the National Assembly approved the securitization of this, about 22.9 trillion of this, based on the fact that about the maximum that should have been granted is about 252 billion. Of course, we know that the policy, the fiscal regulation that the CBN has says that the central bank cannot lend more than 5% of the previous year for federal government revenue to the federal government, and that must be paid before subsequent lendings are done. Of course, those ones we observed in the breach. So you are dealing with then further look at the central bank financial report indicates that about 875 billion seem to be credit losses. We suspect, we're not sure because it was not explanatory, that this may be part of the ACOB borrower program, which many beneficiaries thought or feel that this was part of the national cake they were sharing. Okay, let's move forward, 2 slides forward. Oil production, in the month of August, oil production was about 1.18 million barrels a day, an improvement over 1.08 million barrels a day in July. The key thing is that unfortunately our oil OPEC production quota is about 1.74 million barrels a day, but we are still producing just about 1.18 million barrels a day. And for that reason, OPEC is compelled has been compared to reduce our production quota to about 1.38 million barrels a day. But concerns are not necessarily whether we meet a peak quota. The concern should be whether we even have the capacity to produce sufficiently. I'm sure if we produce, we can go back to them and ask for that accommodation to allow us go back to compensate for the periods we couldn't meet our demand, our production quota. Next. The issues around oil production would remain a challenge in the country. We need, according to Bloomberg, we need to raise our oil production by at least 300 to 400,000 barrels a day to meet the aggressive target of achieving 6%. Okay. Now let's move to the issue around fuel subsidy. I had mentioned earlier that efforts to eliminate some of the big elephants that are being major leakage pipes in the economy seem to be challenged or unraveling. The issues around subsidy has refused to go away. Two things have contributed to that. As you may know, the federal government said that they spent about 169.4 billion naira to keep the pump price at 617 naira, which simply means we've gone full cycle. The most painful aspect of this going full cycle is that we have all suffered some worsening in our standard of living. We moved the exchange rate, we moved the price of fuel. I just had a conference discussion where somebody said he used to fuel his Toyota Corolla, a Toyota car with 18,000 naira. Now he spends about 50,000 naira to fuel it. And that, unfortunately, the primary purpose was that we're going to take some pains so that government resources will be freed up for investment in critical sectors of the economy. But that seemed to be unraveling, like I said earlier, because with 169 billion spent on fuel subsidy, because the federal government said they can no longer accommodate additional fuel price increases. But the more painful aspect of it is that $275 million of dividend that was received from dividend due from investment in Nigerian liquid was used to subsidize fuel. The 169.4 billion was paid from using 220 million of that $275 million. So if that had not happened, probably would have had about $275 million added to our federal foreign reserve. But we hope that we won't go full cycle to the point where about 7.83 trillion naira was spent on fuel subsidies under the immediate past president. The major factors that have driven the resurgence of fuel subsidies. One, we've seen crude rise to $95 per barrel, Brent close to $95 per barrel. So what has happened with that is that ICE has also gone up. But beyond that, we also saw a depreciation of the local currency. So two factors. Moving from 664 naira to $1 when the exchange rate was harmonized to about over 1,000 naira to $1. That's more than a 40% increase. So with that depreciation of local currency, it then means anybody who imports fuel will land at a cost that is above the current price. And if you try to pass it on, you could risk civil unrest. And that's why the federal government said, so, but like I said, the concern is that we have gone full cycle, taking a lot of pain, but back to the same headache. Next slide. External reserve, we'll talk extensively on this. Like I did mention earlier, JP Morgan said your actual net reserve is about 3.7, which for me would barely cover a 1 month. It's less than 2 months of our import bill. And that has created a lot of concerns. Of course, clearly the central bank has limited capacity to intervene in the market, which is why we've seen dollar breach the 1,000 naira mark. Next, because of time. Next slide. As part of efforts by the federal government to help stabilize the exchange rate when it got to over 900, the central bank, NNPC announced that they got secured a $3 billion line loan against crude swap or crude sale to help support the central bank to manage the exchange rate. Unfortunately, that fund seemed to have taken so long to come, as it hasn't come, we've seen a situation where the Afreximbank has invited oil marketers, oil traders to offtake the crude, but it doesn't look like there is strong interest from oil marketers to pay for Nigerian crude in advance, given the concerns around your production capacity. Let's move to DMO. We've seen the national debt has grown to about 87.38 trillion naira, or 113 billion. Even if you take a reserve of 33 billion, your national reserve, your debt has actually outstripped your reserve. The problem is that with this, we have paid over 4 trillion naira in debt service in the first 6 months of this year. And that leaves government with minimal headroom for any development activity without borrowing additionally. Next, unless it grows its revenue, which is what the government is trying to do. If you look at this slide, you will observe that with the limited resources, the government will be hard-pressed to engage in meaningful economic activities without raising additional revenue, which is why the government has set up the fiscal policy review committee headed by Taiwo Oyedele to look at how to improve tax revenue. The government said their target is to achieve a tax revenue to GDP of 18%, so the committee is supposed to come up with necessary measures. Next, okay, here. So necessary measures to achieve this, among which is to ensure that wealthy Nigerians contribute their fair share of taxes, which means they want to tax wealthy Nigerians more than they are currently doing now. Reduce the corporate income tax to stimulate business growth, leverage technology to streamline tax collection and increase revenue, simplifying the tax system by consolidating taxes and improving collection processes, and enhancing accountability in government revenue utilization. So these things are measures. Of course, the federal government last week announced that they have taken out the subsidy, not subsidy, they've taken out the tax, 7%, 7.5% VAT on diesel, but for a period of 6 months. Some of us are the opinion you really can't afford to tax diesel at this point because it is the gas or the energy source for the manufacturing sector. The manufacturing sector are not having sufficient power supply. So if you now tax them, you are further increasing their cost of production at a time when the economy is struggling. So we think it's something the government should put in abeyance until we have a stronger economy. Now, to the stock market, we've seen the Nigerian stock market reach 68,000 points. But I think I want to dwell more on what has happened to the market. If you look at the market trend, prior to the election, the market was going at a very fast rate. You saw when in November, the market gained 8.18%, November last year, December 8.3%, in January 3.18%, February 4.318%, and then in March after the election, immediately after the election, because of the way the election went, the market began to tanked again in April, and then when the president announced the removal of subsidy, the market gained. So and then the market gains was sustained when the harmonization exchange rate was announced. So you can see the gains we've seen in those years, in those months. But unfortunately, when the exchange rate now hit 1,000 naira to $1, the market began to weaken. So the market is actually a barometer to measure the mood of business operators within an economy. But the most important thing that anybody who has invested in the market so far, and you took a basket of investment in all the instruments listed in the market, you would have gained about 29.52% year to date. But that also means that if you are a descending investor, you invested through Cowry, you are likely going to have achieved more than 29.5% because not every stock had gained during that period. Next slide. So among the sectors that drove the bullish activity, consumer goods sector, which gained to 6.56%. In that sector, you had the likes of Northern Nigerian Flour Mills, Elalec, Dangote Sugar, and Bua Food. They are the drivers of that sector. The oil and gas sector gained 17.81%, and while an industrial goods sector gained 6.89%. The oil and gas sector were driven by the removal of subsidy, which people felt that oil traders, because of two things: the upstream quoted company, which is Seplat, was enjoying the benefit of high crude prices, while the downstream operators were enjoying the benefit of the expectation that with the removal of subsidy, their business would no longer be dependent on the government alone. The likes of Oando, Seplat, in the oil and gas sector benefited from this market increases. In the industrial sector is Computer Warehouse, Beta Glass, and then Dangote Cement that recorded gains. The banking and insurance industry gained 3.2% and 1.85% respectively. Of course, the major gainers here are the likes of UBA, Stanbic IBTC, Fidelity Bank. We know the UBA has declared a mouth-watering unexpected performance half year. We know the likes of Fidelity Bank has paid interim dividend for the first time in its history. So these are factors that investors considered in scrambling for the shares of these companies. So if you look at the major, okay, before we go to that, the industrial goods sector had actually suffered a lot. But okay, yeah, these are the top 10 gainers and top 10 losers in the market. So you can see the top 10 gainers are the likes of Oando. In the past, the last 3 months, Oando has moved, has gained 112%. Computer Warehouse has gained 92%. Chams 36%. Northern Nigerian Flour Mills 27%. John Holt 26%, and on and on and on. Then, if you look at the losers, it's GSK. Of course, GSK is leaving the country, so they've lost 20%. You have the Guinea Insurance, the Linkage Assurance, Cordville, the NGS Group, the Young Asian Group. They lost 14%, and then down to Thomas White and Chi PLC. Next. So this is just to give you the impact of the adjustment in exchange rate on the balance sheets of several companies in the country. In the month of June, for the half year, because it's not just the month of June, for the half year, MTN reported an exchange loss of 131 billion. Nestle an exchange loss of 123 billion. Dangote Cement 113 billion. Jais Bank 110 billion. First Bank 98 billion. Nigerian Breweries 85 billion. I need to say something here. The company that are having exchange rate losses are companies who gap their balance sheet in foreign exchange negatively, in the face that, in that sense, they had dollar liabilities that are not backed by dollar assets. They had borrowed dollar or gotten their suppliers to supply them goods on credit, and they have sold those goods in Naira, and they still have the dollar liabilities. So when the exchange rate was devalued, they have to pay higher Naira. They have to take higher volume of Naira to buy the same quantity of dollars they were owing their suppliers. So which meant, and they didn't have the goods again, is to increase the price of those goods to be able to pay back and to balance out. And that's why they have to recognize these losses in their balance sheet. For the banks, most of the banks had different gap in the gap their balance sheet positively. They had dollar assets that was acquired with Naira. So those dollar assets, when you now convert them at the new exchange rate, the other side of the balance sheet that they're backing them up was not as that expensive. So they are now locking in profit from holding dollar instruments that was acquired with Naira. So they had dollar assets without commensurate dollar liabilities. And in that case, if you look at the GT Bank, GTCO, 357 billion, Zenith Bank, 355 billion, Access 244 billion, ETI 103 billion. Some of these balances that these banks are reporting are currency swap they did with the federal government, with the central bank, where they give central bank dollar and central bank gave them Naira. So central bank have to return their dollar at a higher, when they convert that dollar now, Naira is still what it is, but the dollar they give to central bank, when they return it to them, they will convert them at much higher rate. That's why they're recognizing this level of what we call FS gains. Next, we need to quickly move fast. The tailwind we are talking about, apart from the issues around the exchange rate, was also that Financial Times reported that it was downgrading Nigeria's equity from what they call frontier market to an unclassified market status. And therefore, that had a direct impact on investors' confidence on the exchange. Local investors' confidence, because foreign investors are actually not in the market, actively in the market. So local investors were worried that the speculation that we are taking positions in the anticipation that foreign portfolio investors will soon join them and buy up the shares was going to be far-fetched. So we saw a situation where people began to sell down or unwind their equity portfolios. But another thing that we also recognize that some of the equities had actually reason to point that we may say that we're no longer representative of the underlying fundamentals. So these factors contributed to the decline we saw in September and August. Next. So I've talked about this, that we've seen it slow down because of the impact of the FTSE publication and other factors that are impacting negatively on the market. But for the financial services industry, particularly banking industry, they were benefited of the headwind that we saw in the exchange rates. We've seen exchange rates today trade at above $1,000 to $1. Next. Now let's look at the sectorial outlook. The banking sector, the sector had demonstrated an impressive year-to-date return of about 59.6%. We have said that the banking industry is benefiting from, so if Naira depreciates further, because those assets are still in dollars, they will recognize additional foreign exchange gains. And we also know that the banks are enjoying from widened net interest margin, because the depositors are not able to reprice their deposits, because depositors in the Nigerian market are price takers, while the banks are in position to reprice their loans. So the banks are enjoying wider margins. What does this mean? That the banks will remain beneficiaries of the current economic environment. The industry is likely going to expand, but one other thing the industry is also doing, recognizing that the operating capital they need for their business has also increased because of the depletion of the local currency. Take, for instance, those who are banking the oil and gas sector operators. Previously, a 15 KT or 15,000 metric ton of PMS, that is fuel, would take about 3 to 4 billion to finance by any bank. Today, they need between 10 and 12 billion to finance it. So it then means that the bank will require an increase from about 4 billion to about 12 billion in terms of its operating capital. I'm just talking hypothetically in terms of the bank actually needs an increase of at least 200% in operating capital to be able to continue to finance the same volume of business it was financing previously. And many banks are actually going to the market to raise additional capital to meet that operating capital need, non-regulatory capital need. Of course, we also see in the industry aggressively adopt digital platforms, which is also bringing down their cost of operation and enhancing their non-interest income. So the industry will remain vibrant in the coming months. Next. The industrial goods sector, we talked about what happened to the industrial goods sector. But interestingly, there's a price war among the two of the major leading industrial good operators, the Dangote Cement and the Bua Cement. This may impact their bottom line as they try to drive down, compete on price. We know price competition is always a difficult thing to do. The industrial goods sector will remain resilient and promising. We think as the government settles, and we know that the government is now getting the benefit of higher share of sharing of higher FAAC allocation. We've seen the FAAC allocation for the last month, the month of, I think the month of September that was shared last week, was about 1.1 trillion. So we are seeing a FAAC allocation in the region of 1.1 trillion, which then means that the government at different levels should have more resources, at least in Naira terms, to invest in infrastructure. So we expect, and then the new Minister of Works has also said they are going to adopt cement technology to build highways. So this should lead to an increase in demand for cement and other industrial goods. Next, consumer goods sector. We know that for the first time we've seen for the few times we've seen the likes of the breweries going through major difficulties, because we used to previously say that when the economy is bad, the breweries gain. If the economy is good, the breweries gain. But for the first time, we are seeing businesses or households struggling to meet basic needs. And therefore, you should expect that demand will largely be for those basic human needs, like food. So the likes of the Dangote Sugar, the NASCON, Dangote Food, Bua Food, they may all be remain resilient. But aside from that, the other components of that sector may struggle unless if their supply is a necessity. Next. The oil and gas sector, we spoke extensively on this. The likes of Seplat benefited from the increase in price of fuel, of maintenance price of crude. The likes of MRS, Conoil and Oando. Of course, we know Oando that actually bought Agip is not quoted, so it's a private company, so we may not be able to talk about that. But if you look at the ones that are public companies, we've seen growth in revenue, nominal value of revenue, because of the higher prices of petroleum products. But of course, that will also mean that they will report higher profit margins or higher profit, but it's in nominal terms, because, like I said, transaction that used to be done for 4 billion is now done for 12 billion. So the PIA, I think the federal government is actually pushing for a full implementation of PIA, among which is that they are pushing oil companies to make sure they have they incorporate the host community fund and the host community arrangement, so that to see if that will help moderate or reduce the rate at which crude pipelines are bridged by the community and around the communities, so that the host community will be major partakers of what is produced from their environment. So if that's they're able to achieve that, we should expect some uptick in crude production, which is good for the economy. But unfortunately, as it relates to the downstream operators, they are back cap in hand to NNPC trading to get to source for PMS, because nobody can import PMS today. Landing cost of PMS is close, it's more than 800 Naira per liter. So that is FOB, free on board, not when you add the operating cost, other operating costs. So, so the expectations, the only thing I know that will happen in that sector is that because of lower value of Naira, nominally you're going to see higher profit. But if you look at the real terms, there may not be any expansion in their profit performance. Next. Okay, I think I've spoken about this. We know that recently Russia restricted export of diesel because they said we are running short of diesel and they're going to only saturate the local market before they resume export of diesel. Remember that the Western countries had tried to impose restrictions and cap on Russian oil and Russian refined petroleum products, but that has continued to find market in the likes of India and China. So hopefully, but that has also led to an uptick in prices. I did mention earlier that since yesterday, the prices have started moderating. So that if that moderation continues, it could have impact on the likes of Seplat, unless he had gone into forward deals and sold it good forward. We are still expecting to see how the current government will resolve the issue between Seplat acquisition of Mobile producing, given that Oando's acquisition seems to have gone through. The telco sectors will remain the good bride of the economy. There is no gainsaying that we know that MTN and Airtel now have 5G, and they have both launched their 5G network. Abuja is covered by 5G, Lagos is covered by 5G, part of what is covered by 5G, and a couple of other few cities. So the issue about 5G is that it's so fast that you wouldn't know when your data finishes. So the likes of MTN is running to the bank, because when your data finishes, you are going to likely go to reload. But we've seen in terms of performance, many of them suffered exchange rate losses. I want to believe that they would have taken measures to insulate themselves against further depreciation of local currency. So if they've done that, we should expect a lot more positives coming from the telecommunication sector in the coming months. Next. Of course, I'm sure many of you are aware that MTN acquired another spectrum license to further expand its bandwidth or its access to provide data services in the country. MTN has actually become, not just become, has remained the dominant market player in this industry. Next. The fixed income market, we've seen the central bank T-bills offers have not been following the pattern. We see this week an increase in yield and next week a reduction in yield. So there's been a lot of inconsistency as it relates to yield trend when you look at the short end of the fixed income space. At the medium to long end, we've seen yield expand, which means prices have come down, which are also showing that investors are pricing in some of the risk we have discussed as it relates to local currency assets, particularly depreciation of the local currency in terms of exchange rate, and therefore they're seeking for higher yield from local currency assets. What is going for us is that the largest fund managers in the country do not have the latitude to invest in foreign currency assets, so they are stuck with investing in local currency instruments. We are aware that federal government, the Department of Office, is currently issuing a sukuk bond of 150 billion. We think that will be largely subscribed, and we already have that on our platform. So in case you have not subscribed, you can subscribe to us because we know that we have a huge pool of ethical investors who come to buy these instruments in the secondary market. Next. So this is just to give you the trend. I had mentioned that we're seeing an expansion in yield and then contraction in prices of most of our fixed income federal government bond instruments, or fixed income instrument, factoring the risk inherent in the market, as well as the FTSE publication that is likely going to encourage foreign portfolio investors coming into the economy. Next, we're rounding up gradually. So this is just to give you the Q2 2023 bond auction results. You can see the yield. You can see the volume of subscription, the offer amount, the amount subscribed, the amount sold, within those periods, which actually reflect the fact that the local fund managers do not have the latitude to invest elsewhere, so they are stuck with investing in only local currency instruments, and that's why you're seeing this level of subscription for that period. Next, I've spoken about if you look at the zigzag movement in the yield on T-bills, you can agree with me what I said earlier. There seems to be no pattern, so they are sending incoherent or inconsistent message to market operators on which direction yield is going. And like the good thing they have going for them is that it's a closed market, it's a closed economy to some extent for local investors. So they instead of keeping their money completely idle, they will continue to scramble for whatever is available that will give them some level of incremental return, or what they call marginal return on the idle assets. And that's why we're seeing this level of patronage, because if you compare the Treasury-based yield or the 3-4-day bill of yield of 11.37% to an inflation rate of 25.8%, you are dealing with a net negative yield of more than 14%, 14.5%. Next. I've talked about FARC, and the implication of FARC is that it also injects a lot of liquidity, and then those liquidity will be looking for short-term investment instruments to earn some marginal return. I've spoken extensively on what has happened in the FX market. The basic thing that we must recognize is that the challenge we have in the FX market is that at the time of harmonizing the exchange rate, this looked like we didn't take stock of outstanding matured obligations in form of currency swaps, in form of futures, in form of forwards, in form of letters of credit that have matured that have not been negotiated, in forms of due to the airlines, in form of remittances from foreign producer investors that have sold their local currency assets that wanted to take their money out. So if we had taken that, we would have taken a measure of what was outstanding, and they would have tried to raise funding to make sure we clear that. But because that was not done, when the exchange rate was devalued and those businesses have to take huge losses, they began to front load even non-matured transactions to cut down on the risk of additional losses. And that's why we've seen dollar reach the 1,000 naira mark, which we already refer to as psychological mark, because at some point, most Nigerians were thinking that we will never get to 1,000 naira. Okay, next, as I round up, so this is about us. We, an investment banking firm, we provide this investor education to our clients and the general public every quarter, at the end of every quarter. And then we are a fund manager. We have 3 mutual funds. In fact, we actually have 4 mutual funds. We have a dollar fund, a Eurobond fund. We have a fixed income fund. We have an equity fund. We have a mixed income fund. A mixed income fund. We're a broker dealer, and we have a dedicated subsidiary, Carry Securities Limited, that is that trades on all the exchanges, FMDK, NGX, NASD, and even help you buy instruments in other jurisdictions. The parent company issuing house and issuing house. We are currently involved in a number of offers. We are currently involved as co-lead issuing house in Fidelity Bank offer, as one of the issuing houses in Fidelity Bank in First Bank offer. So in case you need to invest in any of these instruments have, or these counters all have, the offers include right issues. So Fidelity is a mixed offer, a hybrid offer which has right and public offer. So we urge you to do that through us. Accountability will be reaching out to you. And then, so that's some of the primary jobs we do. We also act as advisor, financial advisor. We're currently on a couple of mandates today. We have subsidiaries, like I said, in securities trading, in fund management, in consulting, in real estate. So we have actually matured or grown into what we may call a financial supermarket. On that note, I thank you for listening, and I'm available to take your questions.
Thank you so much, sir, for such an insightful economic analysis of the last quarter. So we're not set to dive into the questions and answer. Just we go into that. Please just to reiterate, if you have questions, please drop it in the Q&A box. Like I said earlier on, the link to this webinar and the slide, that's a presentation slides, will be forwarded to your emails immediately after the webinar. So I have some questions here. I'll just take 3 at a time. So we have from Ahmed Musa, what is the problem with instability of Nigerian stock market? Sometimes it favors the investors and sometimes it did not favor the investors. From Mr. Agbara, he said the current government policies seem to stifle domestic investment. What is the government doing to encourage corporate and individual investment activities in this economy? He also went further to say, what is behind the current price appreciation in equities market? Let me take the third question so that you can answer together. Please, is it, okay, so let me take this one. How is the exit price for companies existing in the NGX determined, and why are few companies in the exit list recently? Are you there, sir?
Okay, sorry, I was muted. Okay, like I said earlier, when you talk of instability in the market is a reflection of what happens in the larger society. Policies of government has a direct impact on how the market reacts, because the market policies will either engender optimism or pessimism about the economy. If government policies engender optimism, the market will react positively. If government policies engender pessimism, market will react in that direction. So it's all about the right government policy, getting the policy environment right. As it relates to why some companies what's the basis for the listing? Well, some companies may feel that the benefit of remaining listed are not so much today, if they think they can come to the market and raise long-term funds, or if they think that the post-listing requirements are onerous, and they would rather prefer to remain. Some companies may actually be hiding from the transparency required for a listed company. So, but the key thing is that we must continue to review our listing post-listing requirements to be sure that it's not onerous in terms of compliance to them, and that we also need to create incentives that will allow that will attract companies to get listed. Such incentive could be in terms of differential dividend rate. So for companies that are listed, it could be required to pay dividend withholding tax on the dividend at 7.5%, while companies that are not listed pay 10%, and that will incentivize directors, shareholders to push for companies to be listed. I think that summarizes the 3 questions that were asked.
Okay, so we have another question from Anonymous. So why did you consider Oando as a limited company when the delisting process has not been concluded? Then we have a question from Peter. You spoke about GSK leaving the country. How is its share price has declined by 20% at the end of the day? What happens to the minority shareholders? Then the third one from Ejima. Oando offered its minority shareholders 7.17 now that the price in the market is about 10. How does that plan out?
Okay, the first place, Oando has indicated that they're listing, so there's no point. It will amount to playing the ostrich if we think they are not going to delist. They've gotten their shareholders' approval to delist, so the rest are a matter of processes. So we must recognize them. It's similar to somebody who is brain dead. If you are brain dead, the doctors will tell you disconnect the life support, because life support for a human being, the brain is what doctor would consider as a source of life. So Oando has gotten all their necessary approval to delist, so we must recognize they are delisting. In terms of GSK, of course, GSK clearly, in terms of, if you look at the price, the market price today is no longer a function of the operating business. It's a function of what investors who already stuck in it think they will get from the buyout that the company will engage in. Because the company is actually exiting the country, a local investor do not have strong bargaining power. It's not that the company is going to remain an operator in the country. They are completely leaving the country, which is a painful thing for me and most Nigerians, that some of the companies we've had all our life notice as long-term investors here are leaving because of inclement environment. On those shares which are currently trading above the offer price, the rules are clear on the bid price that companies that want to buy go private can make. So if the key thing is for them to comply to those regulations, if they comply to those regulations, they would not have breached anything. But the key thing is the regulation says it indicates which average should be the basis for the buyout.
Okay, thank you, sir. So just confirm you can still hear me.
Yeah, I can hear you. Can hear you.
Okay,
The
so
other
another question from Anonymous. What are your thoughts on what the government can do to tackle declining Naira value and the rising inflation to boost savings and investments? Then we have another one from Maggie. Please, how is the dollar source for the Eurobond? I would like to invest in Eurobond. Then a third question from Raymond. What steps can be taken by government to reduce and stabilize the exchange rate due to the runaway inflation? Our currency has dealt a heavy blow. What can one do to avoid negative real returns?
Okay, what can government do to stabilize the exchange rate? The first thing is that we must be in a position to clear the areas of unmet demand. People who have sold and they need to go, and they're in desperation. So I had advocated publicly that the government needs to go to a bilateral or multilateral agency and raise funding. The most likely multilateral agency that will give out that level of funding is the IMF. And we agree on conditionalities with them. We need to clear those areas to stabilize the exchange rate as well as stabilize the inflation rate. That takes the second question. So I advocated that we go to IMF and raise long-term funding. It could be a 20-year loan, probably at the concessionary interest rate. That will allow us clear those areas. It's only when you clear those areas that you begin to see stability in the exchange rate. And stability in the exchange rate will also flush into stability in the inflation rate, because the pass-through effect of depreciation of local currency will moderate. So you are only going to deal with inflation pressure coming from food and food items. So that's on that. What can government do to tackle the declining Naira value and inflation? So I think that's among the things they should do. The government must also avoid further ways and means borrowing that leads to injection of liquidity into an economy that is not backed by productive activities. How can you secure dollar? If you speak with any of our officers, they will guide you on what to do to assess to invest in Eurobond, including advice on your dollar sources. So it's something you can send a message to us, and if you're not already a customer in Cowry, we'll assign somebody to you that will guide you in this process. So the other question about Raymond, which is stabilizing the exchange rate, I think I already answered that, which also has a direct impact on inflation. I said our currency have been dealt a heavy blow. What can one do to avoid negative returns? One of the things you need to do is balance your portfolios. So you hold some assets, some part of your portfolio. While you hold some in local currency instruments, you also hold some in foreign currency instruments. Like I said, we have a Eurobond fund. We have a dollar note. These are foreign currency the instrument that will, at the minimum, insulate you from further depreciation of local currency.
Okay, thank you very much for the feedback. So I have a question from Wasil. It's on news that CBN is introducing currency redenomination in 2024, which failed in 2007. Is this the best time to introduce currency reform? Can the reform address our structural challenges, high inflation and weak currency? Then from Anonymous, I want to know how I can commence my wealth creation. Then from Kenneth, the third question, is there any hope for the Naira to gain against the dollar in the short or medium term?
Okay, from Wasiu, I would say that Central Bank has debunked that rumor. And the Central Bank has said they have no plan to redenominate the local currency. But I can also tell you that redenominating local currency is just psychological. It doesn't address the weaknesses of the economy or the weaknesses underlying the currency. Ghana has done it, but the Ghana city has also continued to depreciate further. So the key thing is for me is to address the fundamental issue that will lead to an increase in productive activities, an increase in foreign exchange earnings through multiple exports other than a single export commodity, and then an environment that attracts investors to your local economy. Anonymous that wants to commence wealth creation, I will still advise that send us a mail, info@cowryasset.com, info@cowryasset.com. I repeat, info@cowry, COWRYASSET. It's actually the last slide on this presentation.com, and then we'll assign somebody that will guide you in your wealth creation. We actually do what we call a holistic assessment of investors before we advise them. One of which we look at your age, we look at your income, we look at your earnings, and we look at your risk appetite. And we do diagnostic or technical assessment of your appetite for risk. And then your stage in life will also guide us on whether to tell you to invest in variable income assets or fixed income instruments. So we don't just, our advice is like when you go to hospital and say, let's first carry out a comprehensive check on you to know. It's similar to somebody who wants to go and start exercising. The doctors will always advise before you start exercising, you need to carry out a basic check on your heart to know what kind of endurance you should be able to take. So we don't just give advice, which is why we take so much care of our customers. We treat them like that they're egg. We don't want them to ever die, fall down and break. And so that we need to do a proper analysis of your station in life, your income, your risk appetite. So shoot us a mail at info@cowryasset.com. Is there any hope for the Naira? Well, what I would say is that the optics are not too strong. The issues I mentioned, if they are addressed, then there will be hope for Naira. Naira will not defend itself. It's already on the ground, and dollar has continued to kick it. So we need to bring the big brother to help lift it up, to stand on its feet. And that will come from assessing support from either a multilateral agency or a bilateral partner.
Okay, thank you, sir. From Amaobi, which of the fund can we invest in to hedge against the very high inflation rate at 25.8%? Then Anonymous wants to know, how is the exit price for companies exiting the NGX determined? Then the third question from Alex, how will you advise the new CBN leadership under Mr. Cardoso to tackle some of the critical challenges facing the Apex Bank?
Okay, to hedge against an inflation rate of 25.8%, there are some equity instruments that had performed that. In my presentation, it was clear that I showed some of them had performed the inflation rate. It doesn't necessarily mean that they will continue to outperform the inflation rate. But if you come to go, we're going to give you a basket of instruments. Like I said, we do a proper analysis of who you are, your risk capital, and all those things, and understand the kind of risk you're ready to take. We will look at what is available in the market. It may not necessarily be that you must outperform the inflation rate, but our target is to achieve the highest possible return on investment at the lowest possible risk, because it has to be a balancing act. You're not just going to be pursuing return without recognizing that they also inherent in a higher return is also higher risk. But if you talk to us, we will guide you on that. How do you think the crude oil swap for FX from Afrexim Bank is sustainable in reserving? The key thing is that what volume of free crude you have. I think Nigeria's free crude is highly limited. So there's a limit to what the central bank can do in terms of crude swap to generate enough FX. If they're able to swing this, I think that's actually that should be commendable, because they're already running into difficulties of getting oil traders to take up that swap. So it's not a silver bullet. It's not a silver bullet. We still need to do the hard issues I've mentioned. The exit price for companies from the NGX is determined by the NGX has a rule on determining the price at which companies are making an offer to buy out minority shareholders should make that offer, the price levels. So for each, based on the traded prices of that particular instrument. It's not so they look at the historical traded price, and it must not be. I think it should be the highest traded price. I'm not sure exactly of the past 6 months or 3 months. At the time they're making that offer, but we can check that. This information we can easily avail you outside of this meeting. How will you advise the CBN governor? The first thing that the CBN governor's job is going to be very tasking, because the tools they need to stabilize the exchange rate is not at their disposal. So they will need to go to the executive arm of government and have an understanding on how to raise foreign currencies to help stabilize the exchange. Without stabilizing the exchange rate, they can't stabilize inflation rates. And there are 3 elements of prices that central banks should manage. One is exchange rate, the other one is inflation rate, the other one is interest rate. The two of them, the factors that are impacting them are beyond the tools available to the central bank today. So they need the support of the executive to access funding from multilateral bilateral agency to stabilize the exchange rate. It's only when you stabilize the exchange rate you can talk of stabilizing the inflation rate. The other aspect of inflationary pressure is coming from food production. So you also need the executive arm of government to weigh in on insecurity in the major food belts, as well as insecurity in Niger Delta, so improve on crude production. Those things are outside the core functions or the core tools available to the central bank governor. I guess we still just have a few more questions. Okay. And then, because we're actually running out of time. Okay.
Should we take the last thing?
Yes.
Okay, so Akoshile says, please, these FX gains being declared by banks that fuel the surge in their earnings in the next 1 year, won't we see base effects set in with respect to the year-on-year performance? Then for Omudo says, Owando Court ordered meeting is 10th. Is it possible for the final exit to be below the market price? And then the last question for today, Anonymous say, what should be the primary focus of the new CBN? I think you've even answered this, to stabilize the primary focus of the fiscal authority to stabilize the economy.
Okay, Akosile, he said, please, these FX gains being declared by the banks that fuel the surge in their earnings in the next 1 year, won't we see base effect? Of course, the likes of UBA report is not likely going to be replicated, so we should prepare for base effect. Where you are seeing banks having FX gain of over 300 billion, you don't expect that to replicate unless, and I repeat, unless the Naira depreciates by the same margin again. So they will lock in the same kind of profit again, because those assets are still not converted to Naira. So that's that, but otherwise you should expect that after this year, next year, unless other variables change. But another thing we also have to recognize that I said the Naira value has increased. So in terms of quantum of transaction value has increased. Also, quantum of profit will also increase in terms of the nominal value. For instance, transactions that used to be made, used to make profit of 100 million. Maybe effective because of exchange rate today, that 100 million will be 200 million. So you're going to see that also impact on their profit, but you will certainly see the adjustment in 2024 financials. Yes, Owando exit price could actually be below the market price, but the way market works, that the market will adjust to the exit price because people will start selling if it's going to come out below the exit price. And as they're selling, the market will start moderating to that exit price. That's basically what will happen. We've talked about the CBN, what they need to do. Okay, next questions. Next two questions. I think after that we can.
So from Tony, what's the point of buying a 10-year bond that returns is 15.75 per year when inflation is over 25%? Then Raymond says South Africa and others are coming up with BRICS to abandon the dollar, and there's also currency swap options. Do you think this is a faster approach for the country?
Okay, on the Sukuk, remember that it's a 10-year instrument. It doesn't mean that the inflation rate will remain at 25%. So if you have an instrument you're giving you 15% yield, and the inflation rate in the next 10 years, or maybe after 3 years or 4 years, moderates to 10%, you are still making a positive net interest income. At that point, yield instrument that will come to the market will not be coming at such yield. So the case you're looking at, you're taking a position that, look, with the anticipation that inflation will moderate in less than 10 years, and that you begin to earn positive real interest return. But if you wait for that, by the time inflation moderates significantly, you are not going to see instruments coming to the market at such yield. So that's why you can still take that kind of position today. The talk about the BRICS countries having anything other than dollar may take quite some time to do. The structure of the global economy is that dollar will still be a critical currency in the next couple of years. So it's not what you're going to have is a counter trade by these countries where they trade among themselves. Because even if they generate a currency of their own, if that currency is not accepted by other entities, other countries as a medium of exchange, it will still have some limitations. So I think it's a long-term plan. It's not an immediate thing that they are talking of. And if you even look at these economies they are talking of, apart from China and India, the other economies are struggling. South Africa is struggling. Brazil is struggling. Russia is struggling. So it's not that the economies are very buoyant. So they may not be able to attain a convergence criteria that would allow them easily trade, have a common currency that they can trade with. So I think on that note, I thank you all for listening. Our addresses are here. Our website is here. Our LinkedIn access is here. Our Instagram access is all our social media handles are on display. Fortunately, our email address is not here. I repeat, our email address is info@cowryasset.com. Then if you know any of us and you want to send the person a mail, you just use the first letter of the person's name and then the full surname. Like my name is Johnson Chukwu, so my email is jchukwu@cowryasset.com. So if for instance, is f.osho@cowryasset.com. So if you want to send a direct mail to anybody, any of us, you know his or her full name, just use the first name, the first word in the first name, and then the full name all written together, the surname all written together at cowryasset.com. Thank you once again for listening. We are available to be of service to you.
Thank you so much. I believe the JMD has done justice to all the questions asked, and he has provided deep insights into the economy and what to expect. At this point, I would like to invite the head of internal control in person of Mr. Daniel Udo to give us a vote of thanks.
Wow, what a fantastic time with the GMD. Once again, we want to say thank you to Sir Johnson Chukwu. You know, it's always a pleasure when your fountain of knowledge is being shared and watered down to us and our participants. We want to say a very big thank you to all our participants, our audience, you made this happen. Without you, this wouldn't have taken place. So we appreciate the time you spent with us. We appreciate your listening time and your commitment to being part of what we do. We are grateful. On behalf of the Group Managing Director, Sir Johnson Chukwu, we are grateful for your time. And we know that after hearing what you have heard today, the insight would only make a difference to you if you act on it. And the one way and the sure way to act on it is to reach out to us at info@cowryassets.com. To everyone, thank you for being part of this. Thank you for being a part of our success story. We assure you, and we're confident that if you work with us, your wealth creation will be one that will be tangible. You can actually see it, feel it, and participate in whatever you want to do. For our listening audience, the country today is such that you need to be decisive. You need to be deliberate and intentional to create wealth. The sure way to do it is to reach out to us at Cowry Assets, and we will guide you. Once again, a very big thank you to Sir Johnson Chukwu. It's always a pleasure listening to you. The insight is just one that we just wish it could keep going. Unfortunately, we don't have all the time, and we can't take all the times of the listeners on this web program. Thank you, Sir Johnson Chukwu. Thank you, Folake, and thank you, our listening audience. We are open, our doors are open 24/7. Come to us at any point in time. We are grateful for your time, and we know that when you walk this path with us, wealth creation will be very tangible to you. Thank you for your time. Over and out for me. Thank you.
Thank you so much. Thank you everyone for joining in. Our next session, that's the fourth quarter webinar, will be happening January 2024. We'll be delighted if you can join us, and we'll share the webinar link through our various social media platforms as usual. Thank you all. Do have a lovely day.